Okay, now we will take a look at our performance targets of Eagle Corporation. We start with return on assets. We see that return on assets has actually gone drastically up. Return on assets ratio significantly surpassed our expectations. Eagle Corp estimated that our sales would grow slowly. Our assets would increase with addition of a new line to the Sereno plant. However, for two reasons this was not the case. First, our plant in Sereno never built the 12 lines. This stopped the growth of assets. Second, our sales dramatically skyrocketed as a result of new strategies in sales, marketing, production. As a result of higher sales, the return on assets increased to 5.9. Now, when we go ahead and look at year 6, we see the ROA go all the way to 26.05. Now we look at the return on equity. When we look at the return on equity, we see that it has also gone drastically up. Return on equity was dramatically increased as well because we bought back stock in year 6. However, the factor that most influenced the ratio was our net income. We had an unprecedented increase of net income. In fact, our net income reached $3,170,000 for year 6. Such a drastic increase in sales and constant payback of stock is what caused the ROE to decrease. Also, we refused to further expand our facilities in Sereno, thus requiring more equity. The market share actually maintained the same and slightly dropped. Eagle Corp has maintained the same amount of market share. However, we must admit that our market share slightly dropped into year 6. Recently, our market share had reached 19.4 in quarter 4 of year 6. We are working to expand out market share. We did not increase this area because the marketing was not taken advantage of. Our competitors were heavily invested in advertisement. Eagle Corp ignored this area for year 3 and 4, and as a result, we failed to catch the market's attention. By the time we began using it in year 5 and 6, the completion was heavily controlling the market despite our competitive prices. As a result, we began investing heavily in advertisement in year 5 and 6, which made our market share kind of grow, but it was too late. The stock price actually went up a bit because of our heavy investment and wrong strategy at the beginning of the game. The company incurred heavy losses and thus the stock price dropped. We decided to pursue long-term wealth and not short-term. It is true that short-term decisions can increase the stock price. However, pursuing short-term profits is not the most adequate strategy in the real world. We have seen companies like Enron do such a strategy and they end up bankrupt. We instead decided to concentrate on making the company profitable for the long run. Thus, we heavily invested in building a plant in Sereno. Our debt went up and our sales dropped due to a wrong sales strategy. This caused our stock price to drop. However, when our sales began to rise and debt was reduced, Eagle Corp grew. If the game had kept going, I'm confident that the stock price would constantly grow, given that we had a constant growth in sales and net income. The unit production cost surpassed our expectations for year 5 and 6. This was mostly a result of us moving to Sereno, where we saved money on several direct expenses. We consistently invested money in research and development, which made our goods cheaper in production. Overall, the company was satisfied with our UPC. This would allow us to be extremely competitive if we had to mark down prices, given that we would probably have a very low break-even point. Now, when we look at total income, we also see this great increase. Net income increased heavily as a result of our strategies in many areas of the game. First, our marketing department did a great job investing capital in advertisement. This directly affected our sales and thus our net income. Also, we transferred many employees to different areas where our sales were higher. We also tended to bring new models in when necessary. Our best choice was to change our target market. We were able to control the target market of Sereno, thus helping our net income. Our expenses, including UPC, dropped, which allowed us to have a low production cost and high profit. Overall, I am very pleased with the net income. And that pretty much sums up our performance targets for Eagle Corporation.
Hi, my name is Nadezh Callueng, and I'm part of the marketing department for Eagle Corp. Today I will be discussing the actual versus planned operations and production management. Total R&D spending. For our research and development department, we had planned to spend $360,000 for year 5 and 6. However, we ended up spending a bit more than that. For year 5, we ended up spending $425,000, and for year 6, we spent $490,000. This increase in expenditure was due to our investment in R&D for the latest manufacturing technique for producing Model 4. Product model produced. After the positive results we had gained from Model 3, we plan to keep the same model for year 5 and 6. Unfortunately, our sales were not increasing as expected. Therefore, we decided to develop and release Model 4. Model 4 was the last model released and had brought us positive results and higher sales by the end of year 6. Total training expenses. The planned expenditure for training during year 5 was greatly overestimated due to our expectation of hiring many more employees. For year 6, however, our estimation was much more reasonable. We did not expect to hire as many people as in year 5 because our expenses began to increase. Cost savings level attained. For cost savings level attained, we expected an average savings level of 2. However, throughout year 5 and 6, our actual savings level started to get higher. We were able to attain by the end of year 6 a savings level of 4. Total beginning inventory. The beginning inventory levels from year 5 to 6 had increased. This was due to our lack of sales. As a result of the units not being sold, our inventory began to stack up and increase our inventory levels. Total storage expenses. Just like our estimates for beginning inventory for year 5, our estimate for total storage was underestimated. We planned to sell much more of our inventory, and as a result, we had to pay a greater storage expense. Active production lines first shift. In year 5, we had planned to have 36 production lines. Successfully, we were able to attain that 36 active lines as well as increase our lines by 4 for year 6. However, we were unable to attain the goal of having 48 shift lines by year 6. Active production lines second shift. Eagle Corp did not nor have active production shift lines in our second shift. Production output domestic. Since we had moved our plant to Sereno, we did not produce any output domestically. Production output overseas. We had moved our plant overseas to Sereno and planned a high production output due to our forecast of increased sales. But due to lack of sales, we did not produce as much output as expected. Total units shipped to sales offices. In year 5, we expected an increase in sales as stated earlier, which is why we planned to have shipped a total of 2,166 units to sales offices. Conversely, we were unable to gain that much sales and ended up shipping 1,959 units instead. However, in year 6, we did not plan to ship as much as the year before, but on the contrary, we had shipped a bit more than we planned. Total units shipped to customers. For year 5 and 6, we did not expect an increase in customer orders and had only planned on shipping 1,015 units for year 5 and 1,248 for year 6. In spite of this, we were able to actually ship more than planned. For year 5, we shipped 1,659, and for year 6, we shipped 2,047 units to customers. Our customer orders were more than expected and a lot more than our sales orders.
Okay, hi, my name is Veronica. I'm going to be evaluating the execution of our company's financial strategies. I'm going to start off with actual versus planned numbers for marketing. As far as product price goes, as a group, we planned for year 5 to set our product price to $12 in America 1, 2, and 3. It actually stayed the same in our actual numbers. As far as Sereno, it was also the same. For year 6, as you can see, we projected a bit higher our product price, and in actuality, the numbers were a lot lower. The number of salespeople includes salespeople in training, and our projected numbers for year 5 actually increased by 1 or 2 people for America and stayed the same in Sereno. As far as year 6, we had projected extremely high numbers in the Americas, and our actual number of employees was dramatically low, ranging from 4 to 7 salespeople less than originally projected. Now, as far as the salary levels go, there's not much to say on that, but our salary levels were on target for year 5 and 6. Nothing changed. For the commission rate, our commission rate actual was lower in year 6 due to the fact that the production was mainly in Sereno. And even though it was lowered by just a bit, we still produced great products. As far as advertising expense went, we focused tremendously in advertising in year 5 and more so in year 6. We decided that we needed to attract more customers. By having done so, our sales increased. We were able to attract customers from other companies to purchase our new product that we had just come out with. As far as unit sales, well, in year 5 and year 6, they fluctuated. Our planned numbers were not so great, only because we decided to change our strategy by improving our product and competing in price with other companies. So, although we changed our strategy and it just improved our improved our numbers, we did come out in the end. Next is actual versus plan for financial management. These are totals for year 5 and 6. We projected that we would not have any bank loans in either year. Time CDs were also 0 for both years. Originally, we planned to repurchase 2,000 bonds in year 5, and we actually only repurchased 600. In year 6, we planned to repurchase 2,000 bonds and only repurchased 1,000. We planned in not issuing or buying back stock in year 5 or 6, but in year 5, we actually issued 1,600 stocks. This was so we would have enough stock on hand before price went up. And in year 6, we bought back 530 stocks. This was in order to help increase our stock price for the future years to come. As far as dividends go, we planned on 0 in year 5 and $728.20 in year 6. In all actuality, we did not pay any dividends to our stockholders. The next couple slides basically just break down what I just went over. And yeah, I hope that clears everything up. Thanks.
My name is Sharon Kok, and I will discuss the consolidated financial statements for Eagle Corporation. In the decision-making process, we discussed various methods and strategies that would maximize profit by increasing sales and to lower selling expenses and to follow a conservative outlook in the future. Now, I would like to discuss our consolidated financial statement that includes the consolidated income statement, consolidated cash flow, and the consolidated balance sheet. In our analysis of the consolidated financial statements for years 5 and 6, both our gross and operating profits consistently rose from quarter 1, year 5 to quarter 4, year 6. Although our company had maintained sales levels between $3 million and $4 million in year 3 and 4, our objective was to continue this growth by increasing sales and decreasing costs in year 5 and 6. With this objective, we managed to increase sales from $4 million in year 4 to over $5.5 million in year 5. We emphasize heavily on marketing and R&D to increase net sales. Our group estimated that an increase of 15% in advertising would increase our sales forecast significantly. Based on our actual results for years 5 and 6, our advertising expenses increased from $151,000 in quarter 1, year 5 to $434,000 in quarter 4, year 6, while our gross profit margin increased from $2,171,000 in quarter 1, year 5 to $3,976,000 in quarter 4, year 6. Another objective that we focused on was to cut production costs down, and we decided to sell our plant in America 2 and open a new plant in Sereno to maximize and increase our ROA and ROE. Our company has generated an average ROA of negative 0.4, while the industry has generated an average of 0.7. With this decision, our net income increased, expenses decreased, and our ROA increased to 0.3. However, we still had a negative net income due to the rising admin expenses incurred by the new plant in Sereno. Our company's average return on equity was negative 0.8, while the industry average was 0.8. Although we believe that generating higher net sales would provide our company higher returns and increase in marketing would attract more buyers, our group noticed that our net income began to fall due to fierce competition. However, our total fixed assets decreased from $11,437,000 in quarter 1, year 5 to $5,265,000 in quarter 4, year 6. Overall, our production plan is to produce and deliver at lower cost and higher quality to ensure customer satisfaction and loyalty.
Hi, my name is Vivian Zhang, and I will talk about the actuals versus planned numbers for financial management. We have projected bank loans to be zero throughout year 5 and year 6. We have actual bank loans of $36 million in year 5, quarter 3. In terms of time CD, we project it to be zero throughout the years, with the exceptions of year 6, quarter 4, where we project it to be about 1.3 trillion. For the actual result, we were zero throughout year 5 and year 6. In year 5, we projected that we will buy back our bonds significantly. Instead, we only buy back $100 million in year 5, quarter 2, and $500 million in quarter 3. For year 6, we also projected that we'll buy back our bonds significantly, but we only buy back $2 billion. We project that we will not pay out any dividends for year 5 and year 6, and it remained the same.
My name is Christine Bonilla, Chief Financial Officer, and we will be discussing our consolidated income statement, year 6 variances. Our net sales to customers variance is 50%. We overestimated our net sales to customers. This variance was probably due to the fact that we moved our plant to Sereno, where our strategy wasn't implemented correctly to suit the preferences of the Sereno people. Less cost of goods sold was overestimated by 69%. This overestimation occurred because we didn't estimate the lower prices of Sereno compared to the costs in America. We have a variance of 34% for our gross profit. This again was due to the shift of our plant to Sereno. It took us a few quarters to organize the correct strategy. Advertising expense had a variance of 121%. Our actual number was much higher than our estimate. While we moved our plant to Sereno, sales in Sereno were lackluster. Therefore, to try and boost sales, we increased our advertising expense significantly. The following variances, sales salaries, sales commission, transportation expense had a variance of 35%, which were caused by our misunderstanding of the constant fluctuation of the peso. We estimated for the foreign exchange rate to be much higher during the course of year 6. General selling expense had a variance of 29%. Our actual number was higher because we had to modify our pricing strategy and model changes to adjust for Sereno preferences. Storage expense variances was 176%. Our actual numbers were much higher because we were producing at a capacity with 8 lines while our sales in Sereno declined significantly. We had a large inventory remaining while we reduced our production capacity. We expected our operating profit to be much higher by reducing costs operating in Sereno. The variance of 55% is due to our company having difficulty gaining sales in Sereno and having a negative profit for 2 quarters. Bond interest had a variance of 268%. Our actual number was higher because we needed more cash to finance the plant moving to Sereno. Net profit loss had a variance of 58%, less income tax had a variance of 57%, and net profit after tax had a variance of 59%, all of which were affected by the above listed factors. Consolidated cash flow year 6 variances. Accounts collected variance turned out to be 61% and turned to our weak strategy in Sereno. This weak strategy reduced our expected sales. Interest paid had a variance of 127%, a much higher variance than expected. Interest in Sereno is much more abundant than operating in America. This was overlooked on our part and we didn't figure out the higher interest rates in our pro forma statements. Production costs had a variance of 37%, purchases from affiliates, a variance of 100%, operating expense, a variance of 93%, and taxes paid with the variance of 100% were all affected by, once again, our group's inconsistent grasp on doing business in Sereno. The fluctuation of the peso coupled with the 39% general corporate rate of net income and value-added tax caused us to underestimate these areas in our pro forma statements. Consolidated balance sheet year 6. Our cash balance with the variance of 106%, time CDs with the variance of 100%, accounts receivable with the variance of 71%, and inventory with the largest variance shown on our financial statement analysis with a variance of 555% were due to our declining sales and market share loss resulting from an incorrect pricing strategy of not being a value leader, incorrect product model from not being competitive, and bringing new models and products first to the market. Net manufacturing plant had a variance of 33% along with net manufacturing equipment of 57% due to an overestimation of capital investments to the plant and not purchasing any new equipment because of our low cash availability. Our low cash availability due to declining sales also resulted in us not investing at all in our subsidiaries, resulting in a variance of 100%. Other investments were something our group did not take into consideration when creating our pro forma income statements, resulting also in a variance of 100%. All the above resulted a variance of 59% for our total assets. Accounts payable, a variance of 71%, resulted from an overestimation of increasing business in Sereno. Therefore, needing more materials and with local financing being limited from banks, we believed our accounts payable would be higher. Since taxes in Sereno are significant, we overestimated, resulting in a variance of 51%. The above factors netted a variance of 88% for total current liabilities and 66% for total liabilities.
Our return on assets for year 5 was 5.2%, which means we generated about 5 cents in profit for each dollar in assets. The industry average was 8.8%. The main reason why we produced a low return on assets compared to the industry average was because our net income was relatively lower than the other 4 companies competing in the same industry. Our total net income for year 5 was $778,000, where our competitors' net income surpassed more than $1 million in average. Our property, plant, and equipment amount was enough to compete with the other companies, but unfortunately, our sales were not competitive enough. In addition, we decided to increase our lines to 10 in quarter 3 during year 5, which increased our total assets but not our sales. The total ending assets for year 5 was $15 million. During year 6, our return on assets was 26%, 5 times larger than year 5. The average ROA was 32%, putting us in third place with the highest return on assets in the game. The main reason why our return on assets increased was because our sales were about 4 times higher than year 5, reaching $3 million in net income. We decided to stop increasing lines in year 6 due to the fact that our sales didn't justify an increase in numbers of lines and buying more equipment. Since we didn't obtain more assets and our sales increased, we managed to spread each cent of profit over fewer assets, leaving us with a 26% of profits for each dollar in assets. The total ending assets for year 6 was $11 million. Unfortunately, our return on equity was the lowest for year 5. Our firm generated 9 cents return per dollar of net worth, compared to the industry average of 14%. Our company performance was not productive enough. As explained, the return on assets, our sales were not as good as we expected them to be for year 5, which lowered our total net income. Fortunately, we managed to land third place with our return on equity during year 6. We improved our ROE from 9% to 43%. Sales were about 4 times higher than year 5, reaching $3 million in net income. The industry average for year 6 was 54%, which we missed to reach for only 20% compared to the lowest performing company who obtained 14% return on equity. For 2 consecutive years, we stayed in the 15% market share in the industry. Our marketing department didn't conduct correct analysis and didn't invest enough money in R&D during year 4, which was carried out to year 5, leaving us with a product model with low features and quality in the wrong market. Once we realized that we were selling the product in the wrong market, we decided to move forward with our strategy and follow the other companies where sales were higher due to customers' preferences. Unfortunately, the other companies had already established a first mover's advantage, and we couldn't grab enough market share during the last 2 years of company management. However, we did establish a really strong market share in Sereno. We obtained 26% of the market share during the last quarter of year 6, but it was not enough to move our numbers up from the 50% overall market share. Unfortunately, our company didn't count with the best finance team, and our plan to provide a reasonable level of profitability and assure a reasonable return to our stockholders' equity did not work. We met a couple of financing problems during years 4 and had to get a loan when we ran out of cash. The ability of our firm to pay regular dividends and maintain an increase in stock price was dependent upon its ability to show regular earnings. Unfortunately, due to the low sales during year 5, we had not enough profits to pay dividends, and our cash inflow was just too low to be called excellent earnings compared to the other companies. Fortunately, sales increased in year 6, and even though our stock price was not the highest, we managed to stay on third place competing with the other 4 companies. During year 4, we decided to open a plant overseas. This was an excellent decision to cut costs per unit and obtain a competitive advantage over the other companies. In year 5, we landed on second place as the lowest producer of goods. We had a total unit production cost of 4.65 compared to 5.52, highest among the other 4 companies. During year 6, we were producing enough units to cover our sales and keep enough inventory without exceeding our expenses. Other companies followed our idea to move the plant overseas, but we managed to lower our production cost to $2.45, making us the company with the lowest production cost due to the low labor cost compared to developed countries as it is America. As explained in the market share section, one of our main weaknesses was our late market entrance during the first 2 years of our management. We didn't count on customers' preferences, high quality products with normal features. When we finally observed a trend that improved the other company's sales, we had not invested enough money in R&D and develop a product and grab market share where sales were high. Due to the first mover's advantage the other companies had once we moved to the same market, we were not able to maintain our 20% market share we had started with the beginning of the game. Fortunately, during year 6, we were able to obtain more market share by lowering our prices compared to the other companies and by maintaining the highest amount of sales in Sereno. Total net income increased 4 times larger to $3 million in year 6, putting us in the 3rd place of total net income among the other 4 companies. During year 7, we managed to increase our total net income to $4 million, 5 times larger than the other companies. Total net income increased 4 times larger to $6 million in year 6, putting us in the 3rd place of total net income among the other 4 companies. Unfortunately, the last attempt to succeed in the game was not enough to beat the overall performance of the other companies who maintained decent profits when we had losses for 4 consecutive quarters.